Good afternoon and also good morning and good evening to those of you who are joining us from different time zones. I'm very pleased to welcome you all to this masterclass on the GameStop story. My name is Michal Paserman and I teach in the GEMFIN program, the Geneva Master in Finance. And I'm also responsible for the executive education and master programs at the Geneva Finance Research Institute, GEFRI. GEFRI is the part of the University of Geneva, which is responsible for finance, both research and education. And to start with, I would like to ask you three small questions. I'm curious to know how many of you have an online trading account, such as Robinhood, eToro, or another one. Please take a couple of seconds to respond. So it seems that 38% of us have such online trading accounts and the remainder, they do not. Thank you. Let's move on to the next question, which is about social media. Do you sometimes use social media to learn and get updated and read about finance? And you have three options, either yes, regularly, or perhaps occasionally, sometimes, and no. Okay, so these are the results. So apparently the biggest share of you, 48%, almost half of you use social media occasionally, and we also have those who use regularly. So almost all of you use social media to read and learn about finance. And we still have the 13% that probably read the Financial Times or use other sources of information. One more question, please. Question number 3 is about how GameStop changed your expectations. So what I would kindly ask you now is whether what happened in January with GameStop, how did it affect your perception or expectations? Did it make you more optimistic or concerned about the future of financial markets? Or perhaps it didn't change at all what you thought, or perhaps you're unsure yet about whether it's good or bad. Thank you. So it seems that concerned and not sure seems to be more or less same proportion. And very few of you are optimistic about the future. And for some of you, 22%, it did not really change anything. Thank you so much for your sincere answers. And let's see our agenda for today. Within the next 30 minutes, we're going to have the presentation. We will try to figure out if what happened in January is just a short-term drama that will soon be over, or perhaps it is symbolic of something bigger. Perhaps it already represents some evolution in financial markets. So firstly, we will start by understanding who were the main players in this story and what exactly happened in January. Then we will take one step back and try to see the bigger picture of financial innovation and how it opens up opportunities for us, but perhaps it also entails some risks we should think about. Then I would be very happy for the following 10 minutes to take any questions that you may have about the masterclass itself. And then I'm still going to stay in the Zoom room. For those of you who might be interested in the Geneva Master in Finance program, I would be very happy to answer any questions related to the GEMFIN or studying or living in Geneva. So let's start. So the main player in this story is a company called GameStop. It's a retail company which sells video games and electronics in stores around the world. And its story is actually very, very simple. So it's brick and mortar stores, yeah? When it started, things went quite well. The company generated profits and the price of the stock went up. However, things changed over time. Consumers started buying video games, not in real shops, but rather online. Unfortunately, GameStop failed to adapt its business model to the changing reality. And as a result, it started to losing money. And over the last 6 years, it actually generated losses. Then we have two groups of investors that have recently invested in GameStop. The first group is hedge funds. And sometimes they are called in the media recently like the villains of the story. What are hedge funds? Hedge funds is a specific type of institutional investors that pool the resources of high net worth clients, and by benefiting from economy of scale and special expertise, invest these funds for them. And what makes the strategy of hedge funds a little bit special compared, for example, with other institutional investors like pension funds or mutual funds, is that firstly, they're very more secretive, they're much less transparent and much less regulated. And they are allowed to use derivative assets and short selling. Derivative assets are specific financial assets that the prices are derived from the prices of other underlying assets. The underlying assets could be, for example, stocks like GameStop, but they could also be commodities or mortgages or even the weather. Basically, you can synthetically securitize everything that you want. The second group of investors that is involved here are retail investors, or sometimes called by the media the Robin Hood of the story, or amateur investors or small investors or individual investors. These are lots of individual investors spread around the world. The common type, the profile of these investors, they are young, mainly men and educated. And they have already existed in financial markets for a long period. It's not really new. However, the profile has changed. So, for example, if you compare the retail investors during the dot-com crisis, in 2001, back then the average age was 50 years old. Today it's 31 years old. Back then the average capital that they invested was $48,000. Today it's between $1,000 and $2,000, and that makes a huge difference. Because when you have $48,000 to invest, you're being more cautious and careful compared with if you only invest, let's say, $1,000 or even $500. Then you are willing to take bets, you're willing to risk this money. And another thing is that each one of those retail investors by themselves cannot really make a difference. They cannot really move the prices of anything. However, collectively making decisions, they act like an institutional investor. And in this specific case, they actually acted like a decentralized hedge fund in terms of the strategy that they implemented. And to execute their trades, they're using two platforms. The first one is commission-free mobile trading apps such as Robinhood. And actually, there are more such platforms such as Trading 212 in the UK, Trade Republic in Germany, Pax in the Netherlands. And only 2 years ago, we have just heard from eToro that is going public through SPACs and the value of $10.4 billion. And they are using those platforms. And apparently some of you use these platforms as well, as we have seen at the beginning. And they're also using social media such as Reddit, Twitter, if you like. And through those social media, they exchange information, they exchange their opinions about certain stocks and other financial assets, their analysis, and one more thing that I would like to remind ourselves to understand. There is this line here that I am unsure how to remove. Let's see. What is short selling? Okay, so short selling also played an important role in this drama. What is for short selling? Let's recall. So let's say that we have this short seller. His name is Mr. Pfister. He's a hedge fund manager, and he thinks that the price of GameStop is going to go down because short sellers benefit from situations in which prices go down. So to benefit from this expectation of his, what he's going to do at time zero, so we see here on the left-hand side, the beginning of the period. Well, if he thinks that the price is going to go down, it doesn't make sense to buy the asset now when the price is relatively high. So what Mr. Pfister is going to do, he's going to borrow the stock from his broker and immediately sell it in the market at the market price, which is currently $100. If indeed the expectations of Mr. Pfister realize, then at the end of the period, so we have T1, the price of the asset of the stock is going to go down to 50. But you know, when we borrow things, normally we have to give them back at the end of the period. So he has to give back the stock to his broker, but if he sold the stock, right? So he has to buy it, however, at a lower price of 50 in order to give back to his broker. So by this, he's generating a profit of $50. So that was short selling. And now let's see what happened in January and February. So what we see here a graph. So the dark green line that we see here, this is the price of GameStop. And we can make three important observations here. Firstly, it is clear that the price surged from $18 up to, at some point, it was even $483, okay? This also reflects an increase of 500% within 5 days. And of course, this is an even bigger increase. So that's the first observation. The second observation is the very, very high volatility that the price experienced. You can see it, for example, here. And the third thing is that we can see here is a bubble that burst. Now, what is a bubble? A bubble is a deviation of the stock of the price of the stock from the fundamental price of the company. Now, to decide that there was indeed a bubble here and a deviation from the fundamental price, we firstly have to understand what was the fundamental price. And as I mentioned, you know, GameStop didn't really adapt its business model. It anyway didn't do anything that could justify this surge in the price. And therefore, it was indeed a bubble that burst. By the way, since then, since the burst of this bubble, actually the price of the stock went up again and again. It was not for the fundamentals that improved significantly, but rather because of the very same actors that we will soon see and for the very same reasons. So hedge funds, such as Melvin Capital, for example, realized, okay, the company has been losing money for 6 years now, and it's going towards its final stage. It's going to go bankrupt. The price is 18. It's going to go to 0 probably. And they shorted this stock. But not only did they shorted it, but they actually shorted it heavily. They actually shorted it, the proportion is of 140%. So actually they borrowed more stocks that were actually floating at that time. And that's a bit of an issue, right? Because eventually they have to buy them to cover their position, and it might be tricky to buy more stocks than actually are traded. So as we have all learned, you know, when we studied to learn economics, when we have a limited supply and high demand, what happens to price is that it's going to go up, and that invites short squeeze, which is exactly what our friends of Reddit, the Redditors, the retail investors did. They understood that at some point, I mean, and this is public knowledge, yeah, we know that how many stocks are floating and about the short selling. They understood that hedge funds will have to cover their position, so stock must go up because they were so heavily shorted, and they bought the stock themselves, which caused further increase in the stock price. And at some point on the 26th of January, it was Elon Musk that tweeted GameStop, and this for itself caused an increase of 93% in the price of the stock. And what we can see here is how social media, such as Twitter and Reddit, actually amplify and magnify herd behavior, in which people make decisions collectively, and also what we call halo effect. These are two concepts, herd behavior and halo effect. These are two concepts from behavioral finance. And indeed, as the Redditors anticipated, hedge funds faced margin calls. They had to cover their positions. Price went significantly up. And those poor hedge funds, or perhaps some people don't think that they are poor, that they think that they're the evil here, that thought that, you know, they bought it, they shorted it when price was 18. Now they had to buy it at the price of 500, some of them of 483. So you can understand that they generated very big losses. In the case, for example, of Melvin Capital, they lost half of their capital, which is $7 billion. And by the way, they were not the only losers. Yeah, some of the retail investors that did not go out in time, quick enough from the market, actually lost also money. And some of them actually leveraged their investment. What is leverage? Financial leverage is a situation in which not only do I invest my own capital, but I also borrow capital from somebody else to magnify the return. So if there indeed there is a positive return, I will generate return on my funds, but also on the funds, on the capital that I borrowed. Eventually, I will have to give back my loan, but still I remain with the return that I generated. However, if the other scenario happens, and then I lose money, then I might lose even more than my own capital. I might also lose somebody else's capital. So leverage, financial leverage, magnifies returns, but also losses. And this is what happened here. And now indeed, okay, so yeah, it's still hanging on. Yeah, we still see lots of nervousness, lots of volatility. The price of GameStop is still going up and down and so on. But you know, within 1 or 2 months, this will be over. And my question is indeed, is it really over, or actually are we witnessing something bigger than that? Are we part of an evolution of finance? And to answer that, I would like to share with you a couple of graphs, okay? So the first graph is about social media. So indeed, we know already now that social media plays a very important role in politics and in other businesses. For example, if I have a hotel, I mean, its success could depend on what people are going to say about it in social media. But apparently it has become also very, very important also in finance. What we see here, these are two aspects of the same thing. So we can see here since 2013, the number of subscribers to Wall Street Bet. Wall Street Bet is this specific forum of Reddit that was responsible for the short squeeze. So you can see that the number of subscribers is increasing like exponentially. And you can also see that their participation and engagement and activities very much increasing. So this is the number of comments. And as we can all understand, COVID probably, as you can see here, it contributed to this. So, you know, I've already mentioned that these are young people, you know, without bars, the gym is closed. Some of them are students at the university, you know, many of the universities, most of them actually, we moved to teach online. So they had much more time to spend with social media, which probably was part of this thing. This graph shows something else, which is very, very interesting. What we see here is the ownership of equity in the United States, starting from 1945, okay? So in 1945, you can see the black dark part here. This is the part of equity held by households or retail investors, if you like. And you can see that back then, they held most of the equity in the United States. However, over recent decades, financial institutions such as hedge fund, mutual funds, also some hedge funds as well, started dominating this market, and they marginalized households. Until what we can see about 10 years ago, what seems to happen is a reversal in the trend, and households seem to gain a bigger share now in equity. This is another graph which also focuses on equity in the United States, but it does not show ownership, but rather trading. And if you look at the dark blue line over here, it shows trading by retail investors. And you can see that over the last couple of years, since 2019, it significantly increased. And in fact, today it is equivalent to the sum of both mutual funds and hedge funds. The only one that surpasses it is this Bordeaux color graph, which is high frequency market makers. This is a very, very specific type of investors. My last graph for this is actually not about equity at all. It's about call options. Call options also played a very important role in what happened in January. What are call options? It's a specific type of derivative assets. A call option gives me the right, it's a contract. It gives me the right to buy a specific asset at a specific time in future for a specific price. So when will I benefit from that? I will benefit from that if price goes up. And this is exactly what happened with GameStop. This is another strategy that was implemented by retail investors. And the very important thing is that they are much more risky compared with other financial assets because they have a leverage characteristic. So previously I mentioned financial leverage that happens when we borrow money. But you know, also when you use derivative asset in a certain way, it could act as leverage because with the certain amount of capital that you have, you can buy more contracts compared with the asset itself, magnifying the return that you generate. In fact, and also the losses. In fact, there was a very interesting case last year. Have you heard about Irony Man? He was also a Redditor that was quite active back then. Thank you. And what happened? So he was doing kind of strategy that involved, it was called box spread. He bought several options and he actually invested $5,000. and he generated losses of $53,000. So that demonstrates what leverage could cause. Since then, Robinhood, so since then, I mean, Robinhood took the loss, and I mean, but since then they changed the regulation and the practices. However, that's quite an interesting example. Now, now I would kindly ask you to try and take one step back and try to think more broadly about financial innovation. Basically, what we have seen with those graphs is that a shift of power from financial institutions, from the big financial institutions like pension funds and mutual funds, towards individuals or perhaps smaller institutions. Can you see recently other financial innovation that results in a similar thing? Now, I would be thankful if you could please open your chats. I can see that you have already. Yeah, I'm sorry. I don't know why there are so many Michal Paserman aside of me here. It's not myself. And I see that they also write some comments. I haven't written any comment yet, but I'm very happy that you like my name. Normally it's challenging to pronounce, but anyway, so please write excellent. I see that you already contribute some answers. Excellent. So yes, so please share with us more financial innovation that contribute to what we call decentralized finance. So let me just read. If you wish to remain privately, you are more than welcome to do it in my private chat, and I will not read out your names, but just the answers. Excellent answers. So some of you have written blockchain, Bitcoin, peer-to-peer lending, peer-to-peer Forex, crowdfunding. Excellent. Thank you so much for these excellent answers. You can see there are even more. Artificial intelligence advisors. Perfect. Excellent. Yeah, there are even more. Yeah, it's a fascinating field. I mean, what can I say? So I have also gathered some of those financial innovations. So some of you have already mentioned peer-to-peer lending. And in fact, I'm really, really pleased because I can see in the audience two of my former students that prepared their course project last year on peer-to-peer lending in China. And it was an excellent project and I'm very, very proud of them. And so yes, about peer-to-peer lending. So did you know that today in the world we have 1.7 billion people that are completely unbanked? So they don't have any access to any bank at all, and there are more that are underbanked, that have limited access to banks. You know, so let's say that I'm a small entrepreneur or a small business that I would like I need some funds, you know, to launch my business. So some of us do not even have access to banks at all, okay? Or sometimes, you know, for banks, sometimes the fixed cost cannot be justified by the benefit that they will get from small entrepreneurs like myself. I might end up, you know, using my credit card, for example, and you know that credits are extremely expensive. And this will be so costly that eventually I might give up my project. But today, you know, I have alternatives. So I have online platforms like the peer-to-peer lending, in which I could directly contact a lender, you know, so there are no commissions, no bid-ask spread, everything is much cheaper. And this is that could give me access to fund my business. In a similar way, we have peer-to-peer Forex. So let's say that I'm a small Swiss company and I need to buy American dollars to pay my American supplier for something that I bought from this supplier. What I have to do normally is to go to my bank, pay high fee commission for these dollars that I need. And then I also take part of the the ask bid spread that the bank charges, you know, because banks have to make some profits. That makes things very, very expensive. Today it's not necessary anymore. I can contact the other party through online Forex peer-to-peer platforms. We also have peer-to-peer online payments such as PayPal that are gaining so much popularity. and today they are safe. Yeah, so part of the reason that we have all those innovations recently is due to technological advancements. So today things are much safer in terms of cybersecurity. We have much faster internet today. We have smartphones that perform better. And we also have much more computation power. Another thing that you have just mentioned is crowdfunding. So I don't know how many of you are local here in Geneva, but we have a very sweet and nice chain of Italian restaurants, which is called Vai Piano, in opposed to fast food. And, you know, recently they wanted to open another restaurant and they did it through crowdfunding. So each one of us, you know, the client, some of us gave 100 franc. A franc is more or less like American dollar. Some of us 500. And now we have another nice restaurant. We can go, well, we could still not go there, but hopefully starting from next week, restaurants here in Geneva are going to open. So yes, a colleague of mine actually published a book using funds through crowdfunding. We have, of course, like you said in the chat, cryptocurrencies. So, you know, in the past, these were the central banks that controlled the currencies in the world. This is not the case anymore. And actually Switzerland is the world center for cryptocurrencies. And today in Switzerland, we can pay our taxes with cryptocurrencies. Fractional shares. So let's say, you know, speaking about Switzerland, you might have heard about us that we really like chocolate here. Yeah. So let's say that I would like to buy a stock of Lindt. Do you know what is the price of a stock of Lindt? So the cheaper ones are 8,000 Swiss francs. So almost like dollars. The exchange rate is 1.08. Yeah. And we also have stocks of Lindt that are sold for 85,000 francs. Okay, so I might not have enough funds to invest in Lindt. So if I wanted to buy a fraction of a share in the past, I had to do it through, for example, a mutual fund that pools the resources of many investors and invest it for us. But this is not the case today anymore. Today, I don't really need anymore a mutual fund. I can buy a fraction of a stock of Lindt by myself. You also mentioned robo-advisors or artificial intelligence-based platforms. So, you know, here in Switzerland, in Geneva, we are very famous for our amazing private banks here. So, you know, it's really, this is something you should really try, you know, going to one of our private banks here, you know. So you go to the reception, which has beautiful flowers there, and then the gentleman accompanies you. And it's really like visiting in a gallery because you have such beautiful artwork all around you. And yeah, for some clients, it's really wonderful, but you understand that somebody is paying for that. So today it's not really necessary. Today you can really use robo-advisors, which are basically softwares that you can use from home, and that saves lots of the costs. So yeah, so we have different types of clients. Each one might prefer something else. We also have digital banking like Revolut and Monzo that are gaining lots of popularity, and the mobile trading apps that we have just said. And all of those technologies or innovations actually cause the decentralization of finance, or disintermediation, if you like. So we have different types of institutions now that facilitate things and have many advantages, many benefits. Let's see some of them. So we have already mentioned lower transaction costs, no fees, no commissions, because we don't have intermediaries, or at least less of them, a smaller or not at all bid-ask spreads. We have more transparency in the absence of intermediaries, so there are no commissions and no fees. Things work faster, and that helps financial inclusions. I mentioned this 1.7 billion people who are unbanked. Now they might have alternative sources of funding. That reduces inequality and contribute to investment opportunities. And eventually, the most important thing, it encourages economic growth from which we all benefit all over the world. Having said that, and this is the last one for today, I would be thankful if you could please open again the chat and please try to think, you know, during January, when these events took place, you know, the GameStop, were you concerned about financial innovation, either the ones that were involved or in general? Are you concerned about decentralization or deregulation that we're witnessing right now? I would be thankful if you could please share your concerns with us in the chat. Okay, excellent. Yeah, oh yeah, there was the suicide case. It's so sad. I mean, it's very painful. I don't know who is this Michal Paserman. It's not me, but anyway, thank you so much for this excellent, a zombie company. Yeah. Fraud. Yeah. No regulation. That's correct. Herd behavior is associated with bubbles. Money laundering. Yeah. Speaking about big cryptocurrencies. These are really excellent answers. Thank you so much. High volatility due to emotional investing. Yeah, high volatility is never healthy for financial markets. Yes, I'm really sorry that I cannot read all your answers because you have excellent answers here, but our time is limited. But of course, that everything is available for you in the chat. Thank you so much for these very good answers. Yeah, so now let's try indeed to see whether there are some risks here, yeah, because we have new things. They open up new opportunities, but perhaps also some risks as well. To answer this question, I would like to take, if you don't mind, the historical perspective of financial crises. So what are financial crises? Financial crises are situations of major disruptions in financial markets in which asset prices decline sharply, companies go bankrupt, and this is very harmful for the real economy as well. So that means unemployment, people losing their jobs, and recessions in many cases. And you know, each time whenever there is a financial crisis, everybody says, oh, this time it's different, it's a catastrophe, such a drama. But you know, when you take an historical perspective, you see some patterns that repeat themselves. So in many cases, financial crises, and especially bubbles, are associated with some innovation, whether these are the tulips during the tulipomania during the 17th century. Back then it was an innovation. They were introduced for the first time by the Ottoman Empire to Europe, and especially in the Netherlands. And that happened also with the dot-com companies in 2001. Back then it was an innovative thing as well, and mortgage-backed securities, not so recent, not so long ago. In all of those cases, there was something innovative here. And you know, us humans, we love stories. Whenever there is something innovative, we start being curious about that and trying to think, oh, perhaps I can generate some profit from this innovation. Perhaps Bitcoin is the next. We have to see about that. But you know, so yeah, so when there is lots of demand, price goes up, herd behavior, like you have just said in the chat, contributes to that. But eventually people start understanding, okay, this bubble is not going to inflate forever, and then it bursts, ending up in tears. Another type of financial crisis is associated with liberalization, which is mismanaged, such as with the Mexican peso, or deregulation, or disintermediation. That was also the case, for example, during the 80s and 90s in the United States, with the thrift, the saving and loan crisis. So back then, there was a shift of activity from the big commercial banks that used to give loans, for example, for mortgages, to thrift. Thrift is a specific type of much smaller financial institutions. And these institutions had the capabilities of the big institution, the big commercial banks in terms of giving loans, but they were not equally regulated. Eventually, 1,000 of them went bankrupt, losing lots of money. That was a third of the thrifts. And many people lost their houses and their money. So indeed, over the years, you know, throughout history, you know, technologies change, political regime change, even the height of people change. However, some people remain the same. We have always had financial crises and always will have them on average every 10 years. And in many cases, they are associated with innovation and deregulation. Which indeed brings me to the next question. So we have also seen now that all the recent innovation in finance is indeed causing decentralized finance, less regulation. And just like you shared with in our chat before, these are sources of risk. Okay, so I have gathered here some of them, which I would like to give you as food for thought. That's our last slide for today. And indeed, an intriguing question would be, will these sources of instability and risk eventually lead to the next financial crisis? So I would like to thank you all so much for your active participation and excellent ideas.